Welcome back, Smart Money Moves USA viewers, to today's Explainer. We are getting right into it, connecting the dots between massive, sweeping macroeconomic indicators and the very real corporate distress happening on the ground right now. Understanding this connection is absolutely crucial. We're living in a moment where the headlines are just dominated by optimism, but beneath the surface, the foundational mechanics of the global economy are shifting rapidly. For focused investors, understanding how a change in a government bond yield halfway across the world can directly cause a business down the street to miss a payment, well, that's what separates the professionals from the amateurs. We're looking at a global financial landscape flashing some seriously complex signals, and today, we're going to break it all down. Here is our top-down agenda for today. 1. The 2007 warning signal. 2. Global markets react swiftly. 3. The travel sector collapses. 4. Geopolitics crush construction profits. And 5. The hidden corporate debt crack. I want to kick things off by posing a critical question to you. Are we ignoring the ultimate warning sign? Right now, we're seeing incredible optimism, honestly almost a state of euphoria, in certain sectors of the market. AI stocks are booming, tech giants are rallying, major indices have been flirting with all-time highs. It is incredibly easy to get caught up in that momentum. But as focused investors, we really have to ask ourselves if this high-flying enthusiasm is actually blinding us to a massive underlying red flag that's quietly waving in the background. That red flag can be summed up with this single crucial number: 5.19%. Just last night, the interest rate on 30-year American government securities jumped to this exact figure. Now, why does this matter so much? Well, the 30-year U.S. Treasury yield is essentially the anchor of the entire global financial system. It represents the foundational cost of borrowing money over the long term. It dictates mortgage rates, it influences how much it costs corporations to fund new factories, and it sets the baseline for the cost of capital worldwide. So when this specific bond yield spikes to 5.19%, it means money just got significantly more expensive for decades to come, and that sends shockwaves through trading desks globally. Okay, let's dive into this. This isn't just some overnight anomaly. This yield has actually been on a steady, relentless 6-year climb ever since the pandemic. What we are witnessing right now is the definitive end of the free money era. For years, investors and corporations just grew accustomed to rock-bottom borrowing costs. But this steady march upward, culminating in the staggering 5.19% peak, represents a massive structural shift in the very foundation of global finance. It literally changes the calculus for every single investment decision being made today. Section 1. The 2007 Warning Signal. The last time the 30-year American government bond hit 5.19% was back in June 2007. And that date is absolutely burned into the minds of institutional investors for a very specific reason. June 2007 is exactly when the very first signs of the global financial crisis appeared in the credit markets. What's truly terrifying to market historians is how equities behaved back then. After the bond market flashed that 5.19% warning, the stock market largely just ignored it. Equities kept rallying for an entire summer, peaking a full 3 months later before the floor completely fell out. And today, we're seeing a remarkably similar psychological setup. Shares are flying high again, seemingly ignoring the glaring warning signal flashing right from the bond market. Now, I want to be entirely clear and completely impartial here. This time actually is very different to 2007. Reaching this milestone doesn't necessarily predict that a direct repeat of the global financial crisis is imminent. For one thing, banking regulations are vastly different today. Post-2008 reforms like Dodd-Frank in the US and the international Basel III standards mean major financial institutions have significantly more capital padding and liquidity than they did back then. We aren't saying the sky is falling. However, investors are still incredibly unhappy about this data point because even with stronger banks, the macro parallels are just too significant to brush under the rug. The echoes of 2007 are loud enough to demand our full attention. Let's move to Section 2 and see how this builds. Global markets react swiftly. The reaction to this macro anxiety has been immediate, and it's been severe. We saw local share markets drop sharply today, entirely wiping out yesterday's gains and pulling the broader market down nearly 2% for the week. This directly followed steep falls in New York last night and across Asia today. What is truly fascinating, and definitely concerning, is that this global sell-off gathered pace despite a small fall in oil prices. Normally, a drop in oil offers markets a bit of relief, right? Because cheaper energy means cheaper transport and lower manufacturing costs. The fact that markets dumped heavily anyway shows just how deep the fear surrounding these bond yields really runs. Major companies like Brambles added to a staggering 20% fall, while major banks and miners were just battered across the board. And the volatility isn't isolated to just the stock market. It's tearing through currency markets as well. The Australian dollar briefly slipped below 71 US cents for the first time in a month before clambering back. This kind of sudden currency fluctuation is a classic hallmark of broader systemic nervousness. When a domestic currency slips like this, it immediately impacts the real economy. Imports instantly cost more, which fuels domestic inflation, which then squeezes local businesses that rely on buying goods, parts, or services from abroad. Section 3, Travel Sector Collapses, focusing on Webjet. And this brilliantly illustrates what happens when macro fears hit corporate reality. The results are absolutely brutal. The share price of travel giant Webjet has crashed to a record low. They've now fallen more than 50% since the start of February. Just think about that for a second. Half of the company's entire valuation, representing millions in shareholder equity, simply evaporated in a matter of months. This isn't just a result of vague market sentiment either. It's driven by verified, ground-level business metrics. First off, overall travel bookings have completely collapsed as consumers, squeezed by inflation and higher interest rates, just cancel their discretionary spending. But the really fatal blow comes from the supply side. Virgin recently cut its commissions for travel agents. Companies like Webjet operate as middlemen on razor-thin margins. They rely heavily on those airline commissions to turn a profit. So when an airline cuts those payouts to save their own bottom line, they effectively starve the middlemen. Combining a total drop in consumer bookings with slashed revenue structures creates this perfect storm that is just violently punishing these stocks. Let's look at Section 4, Geopolitics Crush Construction Profits. The pain isn't just in discretionary sectors like travel either. We have a very stark admission from the construction giant James Hardie. They've explicitly stated that the geopolitical conflict in Iran is directly forcing the prices of its building products higher. Now, how does a conflict in the Middle East translate to a piece of building material costing more? It all comes down to supply chain friction. When international tensions rise, global shipping lanes get rerouted. They take longer, they burn more fuel. Insurance premiums for cargo vessels just skyrocket. The petroleum-based raw materials used in countless building products become far more expensive. It's a perfect example of how complex events thousands of miles away ripple directly into the material costs of major international corporations. When those input costs skyrocket due to geopolitical friction, and a company simply cannot pass all of those sudden price hikes onto an already squeezed consumer, the company has to eat the loss. The result here? A staggering 75% plunge in profits for James Hardie. It's a breathtaking collapse in profitability. This is exactly what the macro to micro cascade looks like in real time. For investors, this corporate fallout brings an immediate, painful consequence. Because of that massive 75% profit collapse, the company announced that its dividend would be entirely dropped. And we really cannot overstate the psychological impact of a dropped dividend. For many long-term investors and retirees, a reliable dividend is literally the primary reason they hold the stock. When a blue-chip company cuts it to zero, it breaks the ultimate promise to shareholders, and that often triggers massive panicked sell-offs, further depressing the stock price. So, the crucial point is in Section 5, the hidden corporate debt crack. This brings us to our final and perhaps most insidious economic indicator today, business-to-business trade arrears. Just to be completely clear on the definition, this refers to unpaid corporate invoices. It measures the delay in businesses paying other businesses for their goods and services. Let's put this into perspective. Imagine Company A delivers a massive order of lumber to Company B. Company B says, hey, we'll pay your invoice in 30 days. But 30 days becomes 60 and then 90. Company A still has to pay their own staff, their own rent, their own taxes, but they suddenly have no cash coming in. Trade credit is the grease that keeps the economic engine running smoothly, and right now, that grease is completely drying up. Now, what's really interesting about this is that both 60-day and 90-day trade arrears have quietly spiked to alarming 6-year highs. This represents a massive, undeniable upward trend. The level of unpaid invoices and delayed payments is now perfectly matching the severe economic gridlock we saw during the absolute worst of the pandemic-era lockdowns. When businesses start holding on to their cash and delaying payments to their vendors, it's a glaring sign that corporate cash flows are under extreme distress. Think about the sheer irony of this reality. The data tells us that businesses are as slow at paying their invoices right now as they were in the pandemic. On one hand, you have portions of the stock market that have been flying high, acting as though the economy is roaring and everything's just perfectly fine. On the other hand, down on Main Street and in the back offices of everyday corporations, businesses are struggling to pay their basic bills just as much as they were when the global economy was literally locked down. It is a massive, incredibly dangerous disconnect between market perception and economic reality. So we've cascaded all the way down from the top. We've seen a 5.19% bond yield ringing the 2007 alarm. We've seen how that translates to collapsing travel bookings. We've mapped out how geopolitical friction causes 75% profit plunges. And we've uncovered how businesses are simply unable to pay each other on time. The data is absolutely clear, and the structural cracks are showing in the foundation. So I leave you with this final critical thought to carefully consider today. If the 30-year bond is ringing the 2007 alarm, is your portfolio prepared for the echo? Thank you so much for joining me for this explainer. Stay sharp and keep learning.